Hey guys, and welcome back to another video. In today's video, I'm going to be covering something that we get a lot of questions about, and that is what happens if my bond defaults, and I'm going to be covering what exactly the chances are of three different types of bonds defaulting. We're going to be going over corporate bonds, treasuries, as well as municipal bonds. Now to go over the first part, what exactly is a bond default? The basic concept of this is the idea of not paying interest and or principal at the time that it was agreed upon. So this can really mean two things. Number one, it can mean you don't receive your interest payment, whether that be monthly, bi-monthly, bi-yearly, whatever it be, you're not receiving it at the time or at the amount that the bond issuer told you you would. Or it can mean that they don't pay the principal, meaning when the bond finally matures, whether that be 5 years, 10 years, they aren't able to pay you the full amount. Now, obviously, for many people that are more fixed income type investors, this is exactly what they're trying to avoid with the stock market, is all of this risk and possibility of losing money in the process. So let's talk about what the chances are of this actually happening to you. Starting off with corporate bonds, you might be able to guess these will be your bonds issued by corporations or companies. So let's go ahead and have a look at how likely these bonds actually are to default. You can see that these are separated by year, which is something that is important because if we go ahead and have a look at our default percentage, you can see that usually, especially in the last 20 years or so, this stays pretty low. Starting in about 2004, you can see that this is almost always at or below 1%, meaning only 1 in 100 of these bonds is going to end up defaulting. Another important thing to keep in mind is the time that you're investing in bonds. You can see, for example, in the 08-09 catastrophe, this went up as high as around 4.2%, and even during 2020 when we had that little market crash, it went up to almost 3%. Now, one thing this doesn't keep in mind that is extremely important is what types of corporate bonds you're buying. And you can see if we scroll up that this is actually separated into two different types with investment grade and speculative grade. Now this chart does a lot better job of breaking it down. Your investment grade bonds are going to be AAA through BBB, and your speculative grade bonds is going to be anything below that. So your BB, single B, and your Cs. So really bonds are like grades in school. We all want more A's. And if we go ahead and have a look at even the more troubling times that we talked about, for example, in 08-09 as well as 2020, we can see that the bonds that were issued by more creditable sources are still okay, especially with 2020. We can see the only bonds that actually defaulted were BB, single B, and our Cs. Any bonds that were in those investment grade ranges were completely fine. Stay tuned because we're about to talk about your treasury bills, bonds, and notes and their chances of defaulting. But first, let's go ahead and have a look at the importance of the sector from which corporate bonds come. Let's break it down into two main parts with financials and non-financials. You can see if you have a look at this chart right here that the odds of defaulting go up 2 to 3 times if you're buying from non-financial corporations. Now let's go ahead and talk about US treasuries. Whether this be bills, notes, or bonds, we oftentimes hear that the US Treasury has never defaulted. And while this might be true in the larger perspective, if we want to get nitpicky, the US actually has defaulted 3 different times. The good news is that this hasn't happened in a long time, and when it did happen, it honestly wasn't a super big deal. But just in case you are curious, the first time happened in 1814 during the war with the British. A lot of us, well, really none of us were alive during this time, so let's not worry about this one. I'm guessing almost none of us were alive during this one either, but if we have some older end viewers, in 1933, President Roosevelt refused to pay his bondholders with gold, which was part of the specific contract. Once again, this is pretty irrelevant to us. We're not paid with gold anymore, so let's move on to the third one. Now this one certainly could be a little bit more relevant to some of us. In 1979, the Treasury missed payments on $122 million in Treasury bills, which might sound like a big deal, but then we read that it was just due to a technological issue, and they repaid it with the interest included. So really, if you were to say that the US Treasury has never defaulted and we don't need to worry about it, I would say that this is partially true. Honestly, it never really has defaulted, but I really like this quote right here that talks about the fact that because it's never defaulted, we don't truly understand how catastrophic or how big of a deal it would be if it did default. Now, what we do know is that US Treasury securities are backed in full faith by the government. This is a good thing because obviously if citizens can't even trust their government to pay them back for their debts, then we are going to have some huge issues, and hopefully we never get to that point. Now, the last type of bond that we're going to talk about is municipal bonds. These are bonds that are issued by smaller stages of the government, such as cities or states, and they also come with a lower default rate than corporate bonds. You can see that these are split into smaller categories. We're not going to talk about this in today's video, but we have general government, municipal utilities, and competitive enterprises, with competitive enterprises being the riskiest, but still only having a default rate of around 0.35%, and the other two are closer to 0.03%, meaning they're probably not going to default. This graph shows that comparison between municipal and corporate bonds, and it does it in a cumulative manner, meaning the years that are shown 1 through 10 tells you what percentage of the bonds had defaulted by that year. So if we have a look at our investment grade municipal bonds, you can see in year 3 there is 0.02%, and even by year 10 we're still under 0.1%, we're at 0.09%. Compare this to corporate investment grade. By year 3 we're already at 0.42%, and by year 10 we're at around 2.23%. Once again, with these graphs, we can also see the huge difference between investment grade and speculative bonds, with our speculative grade, even with the municipals, still being at 6.84%, and with our corporates, it's even scarier at almost 30%. One of the reasons that municipal bonds are so much safer than corporate bonds is the simple fact that the budgets within states and cities have been swelling significantly in the last couple years, leading to more cash reserve, which means more safety to repay their debts. I hope you did go on to enjoy today's video and learn something new. If you have any questions, throw them down in the comment section down below. While you're down there, leave a like and subscribe. But other than that, we'll see you in the next one.